Welcome to the deep dive. We're cutting straight through the complex jargon of earnings season today.
Yeah, delivering the strategic signal you need.
Exactly. Today, we're focused squarely on Scott's Miracle-Gro SMG and their recent Q4 and full year 2025 earnings call.
And, the overriding takeaway for management, their explicit mission, it seems, is this pivot. They want to reposition SMG as a, quote, safe harbor, high return equity.
A safe harbor, huh?
Yeah.
So less drama.
That's the goal. Eliminate the financial drama, as they put it, by focusing ruthlessly on that core, high margin U.S. consumer business.
Okay, and on paper, they really delivered the goods for 2025.
Yeah.
But if you watch the market reaction,
yeah.
Well, it was immediately cautious. You saw these fantastic operational beats, right? But they were met with skepticism about the forward narrative.
Yeah, it tells us the market isn't really focused on last year's recovery, strong as it was. It seems fixated on the strategic execution, what's planned for fiscal year 2026.
That's the key tension then. Okay, let's look at the financial snapshot for fiscal 25, because these numbers, well, they show that operational strength pretty clearly.
They really do. So non-GAAP adjusted earnings per share, EPS, finished at $3.74.
Which is way up from the prior year, right?
Oh, yeah, significantly, up from $2.29. And adjusted EBITDA hit $581 million. That's a solid $71 million improvement year over year.
And maybe most importantly for financial health, free cash flow. FCF.
Right, the cash left over after CapEx.
Exactly. That exceeded expectations, came in at $274 million. That kind of cash generation gives them critical flexibility.
It absolutely does. And you see that operational momentum in the U.S. consumer segment's performance, too. Net sales there are up a cumulative 7% over the last 2 years.
Which is right in line with their long-term target.
Precisely.
But I think the stat that really jumped out at me was the volume growth. The point of sale, the POS unit growth, surged 17.5% over 2 years.
Yeah, it's huge. That's 8.5% unit growth in FY25, stacked right on top of 9% from the year before.
So this isn't just price hikes driving sales. Consumers are actually buying more stuff.
That's right. It shows real category resilience. But, despite those incredibly strong operational beats, management immediately projected conservatism looking forward.
Ah, okay. So the FY26 guidance.
Yeah. The updated guidance suggests, low single-digit sales growth for U.S. consumer. And the adjusted EPS guidance range they gave was $4.15 to $4.35.
So wait, they just delivered spectacular volume, great margin improvement. Why the conservative guidance? What's the market worried about here?
Well, it seems like it's twofold. First, just general macroeconomic uncertainty, how it might impact cyclical consumer goods.
Okay, makes sense.
And second, strategic execution risk, particularly around that complex cleanup of the Hawthorne segment. We should definitely dig into that later.
Right, so investors are kind of waiting for them to prove the cleanup is really done before giving them credit, before awarding that higher valuation multiple.
That seems to be the story.
Okay, so let's unpack the core strategy then. The thing they believe will create major value going forward. This margin reinvention. The improvement this year was, dramatic. How do they sustain it, and what are the levers for continued expansion?
Yeah, the improvement was stellar. The non-GAAP adjusted gross margin rate increased 490 basis points.
Almost 5 full percentage points. That's huge.
It is. They finished FY25 at 31.2%, which, easily blew past their 30% target.
Phenomenal efficiency. And they aren't stopping there, right? I think the CEO mentioned the public guidance is conservative.
That's right. He stated the public guidance is set conservatively at least 32% for FY26. But internally, yeah, they're aiming even higher, maybe approaching 33%.
So what's driving that confidence? Where's the extra margin coming from?
It's this intentional strategic mix shift.
Yeah.
And a really ruthless ongoing process they call SKU rationalization.
SKU rationalization. So basically cutting products.
Yeah. Say you stock keeping unit, every distinct product, they're intentionally cutting or, de-emphasizing the low margin, high volume commodity stuff.
Can you give us like a concrete example? Because this sounds like a really core change in how they manage their retail presence.
Absolutely. The prime example they gave was mulch.
Mulch? Okay.
Yeah, it's a commodity product, barely profitable. And worse, the volume was so high, it often maxed out their internal production capacity.
So they had to use third parties.
Exactly, just to fill retailer orders. The CEO actually called those sales empty calories for the bottom line. So by pruning those units, they're prioritizing high-margin branded growth instead.
That makes perfect sense. Why sell $1 of almost profitless mulch if you can substitute it with $1 of high-margin branded fertilizer.
Precisely.
And speaking of branded growth, they mentioned redirecting those huge investments they make with retailers, the activation dollars, almost $1 billion annually.
Exactly. Those investment dollars are shifting strictly into higher margin branded products now. The mandate for every team is apparently crystal clear. Any SKU rationalization must be margin accretive.
Meaning it has to improve the overall margin profile.
Right. And they have to replace any lost top-line revenue with higher quality, higher margin sales. So this continued expansion relies on, well, modest pricing actions and structural cost savings projected around 1% of sales.
Okay, so beyond just trimming the fat, they're also aggressively reinventing whole categories. The lawns business, for example. You mentioned an insight there.
Yeah, this was fascinating. They realized consumers weren't necessarily trading down to cheaper products. They were simply stepping aside from lawn care altogether.
Stepping aside. Why?
Because it felt too complicated, maybe too expensive.
Ah, okay. And that led to a strategic shift.
A dramatic one, yeah, in how they market and sell. They're moving marketing focus away from those big, expensive, single-bag combo solutions, like the triple action product.
Okay, so less of the one-and-done approach.
Right. They're now emphasizing multiple feedings. It's a frequency play.
And here's where it gets really interesting for the consumer, I thought. They're launching a new Turf Builder line, specifically formulated to encourage feeding the lawn 4 times a year.
Yeah, and critically, they work to hit a key consumer price point, making a full season of care cost about $100 for an average-sized lawn.
That $100 price point feels like a huge psychological lever.
Totally. It breaks down that perceived barrier of those old combo bags, which, could cost $70 or $80 for just one application.
Mm-hmm.
This makes it seem more affordable and simplifies it into like a scheduled routine.
That structural change in lawns sounds huge. But they're also firing on other growth cylinders too, right? E-commerce.
Oh, yeah. Their e-commerce business is now 10% of their overall point of sale. And get this, the POS units grew a staggering 51% in fiscal 2025.
51%.
Yeah, they see capturing that conventional retail share online as like a $500 million opportunity.
What innovation. Organics.
Don't forget the innovation engine. They called their organics portfolio their fastest growing product line ever. And they're making a major push with the Ortho Control brand too.
Ortho. Okay.
Planning to launch over 10 new Ortho Control products. That's a massive, $5 billion category. And they're using new marketing approaches, trying to tap into a younger demographic through social platforms.
Okay. So we've got this clean, profitable core consumer business. It's growing units, expanding margins dramatically, innovating across multiple channels. This really should be the story.
It should be.
But as you mentioned earlier, the market seems consistently distracted by the complexity and uncertainty around the Hawthorne gardening segment.
Yeah, and that distraction, it's somewhat warranted given the history. But the good news here is management confirmed Hawthorne was actually free cash flow positive and contributed positive EBITDA for the full year 2025.
Okay, so it's not bleeding cash anymore. That gives them a much stronger position to divest from, I imagine.
A much better position, exactly.
So let's detail the final phase of that portfolio cleanup. This is where that execution risk the market is worried about comes in. They already sold off smaller bits like the collective and international horticulture.
Yeah.
What's the final big move?
Right. The final step involves combining Hawthorne Gardening with a dedicated cannabis entity. The goal is to create a unique integrated company.
Okay, integrated first.
Yes, and management confirmed they are laser-focused on completing this, not just to spin it off cleanly, but critically to preserve an estimated $600 million tax benefit through this specific process.
Oh, whoa. $600 million. That tax benefit is a massive chunk of shareholder value. Preserving that must be paramount.
Absolutely. Management stated very clearly that ensuring no more cash flows into Hawthorne and preserving that tax shield were key directives right from the board.
Okay, so this financial recovery, the cleanup, it all directly enables more shareholder-friendly actions, right? Leverage is coming down.
Exactly. Leverage, the company's debt level relative to earnings, is expected to drop into the high 3 times range in FY26. And that's kind of the threshold that opens the door for significant capital return.
And the CEO confirmed a major potential tailwind for investors, one that is not currently baked into that conservative FY26 EPS guidance.
That's the kicker. He's putting a multi-year share buyback program before the board, targeting somewhere between $500 million and maybe $1 billion over time.
$500 million to $1 billion in buybacks.
Yeah, for implementation starting in fiscal 2026. If that gets implemented, that stock buyback will significantly boost earnings per share. It makes the current guidance look, well, very conservative indeed.
Okay, fascinating. Now we transition into our final segment. And just a reminder, this is purely intellectual consideration based on the strategic narrative we've pulled from the call. This is not financial advice.
Absolutely not financial advice. But okay, we've seen the company's internal roadmap, right? So here is a bold, maybe outrageous, but plausible trade idea.
Lay it on us.
The core thesis is basically this. The market right now is valuing SMG like it's this complicated mixed portfolio cyclical goods company. Why? Because of that lingering risk from Hawthorne and their past exposure to commodities.
Okay, so that legacy perception is depressing the valuation multiple on what's actually become a high-quality branded consumer business.
Exactly. So the trade itself becomes a pure play bet on successful management execution.
How would you structure that?
You could initiate a long position in Scott's Miracle-Gro SMG stock, but then to hedge against those general economic slowdown worries that cyclical concern the market, has you pair that long position with a short futures contract against a broad consumer staples index.
Okay, so you're trying to isolate the company's specific factor.
Precisely. This strategy isolates the bet. It becomes a pure play wager on the successful and critically tax-advantaged spin-off of that new cannabis horticulture entity.
A Hawthorne piece.
Right. If management successfully pulls it off, preserves that crucial $600 million tax benefit, and really achieves that targeted profile of a pure lawn and garden company, a high-quality, predictable branded goods business, then the resulting valuation multiple on that core business should dramatically re-rate upwards.
And that re-rating, driven by the cleanup and the high margin profile, would theoretically overwhelm any short-term macro headwinds, which is what the short index position hedges against.
That's the idea. High risk, potentially high reward. And it's contingent entirely on them completing that Hawthorne deal, probably sometime in 2026.
It's a complex trade idea, but it follows directly from their own stated strategy.
It's definitely built entirely on their own self-help roadmap.
Okay, let's wrap this deep dive up then. Key takeaway. SMG delivered operational excellence in fiscal 2025. Huge strides in margin expansion, cash generation, and really critical branded unit growth across lawns, e-commerce, organics.
Yeah, and they have clear, pretty aggressive plans for strategic execution in FY26.
But the central tension you need to monitor is this clash. The management message that branded strength plus the portfolio cleanup will accelerate growth. That message is currently clashing with the market's focus on that conservative forward guidance.
It's that classic disconnect, right? Multi-year strategy versus quarterly headlines.
So what does this all mean for you, the informed observer? Well, here's a final thought. The CEO has actually incentivized internal teams to drive branded growth to exceed 5% in FY26. It's part of their compensation plan.
Tied to potentially massive paydays.
Exactly. So will that aggressive internal metric driven by compensation ultimately outweigh the publicly stated low single-digit sales growth guidance?
Yeah.
That gap, between public caution and internal financial incentive, that feels like the real metric to watch throughout this next fiscal year.